Welcome back from lunch, everyone. Our next session is on financial inclusion. We received a lot of papers on this topic, and I think it's just become an increasingly important area and interesting area of research. And the first paper we've got is John Berger and Jeremy Schwartz presenting Inequities in Equities, What Explains the Black-White Gap in Equity Market Participation.
Thank you to the organizers. Apparently there was stiff competition for this session. That was good news now to know that we made the cut. We're going to talk about the black-white gap in equity market participation. My co-author, Jeremy Schwartz, is here too, and we're going to do a little quick tag team just to try and entertain you and keep you awake after lunch. So as a motivating, stylized fact, very well documented, but still rather astounding gap in wealth between black and white households in the United States. Whether you look at the mean or the median, we're talking about a ratio of 6 to 7 to 1 between white and black household wealth. And this gap is remarkably persistent. Okay, as you can see here, the past 40 years, there's been almost no progress or no change in this ratio. We're going to be looking at one potential factor that might contribute to that gap, and that being equity market participation. There is some previous work. In the interest of time, I'm only going to really talk about one study here, Gutter and Fontes. They look at stock market participation, and even after controlling for a large number of factors, including income, education, risk tolerance, etc., they find a statistically significant difference where white households have greater participation in equity markets. And in their conclusion, they speculate a bit about the fact that it could be attributable to some sort of barriers to entry or information issues in equity markets. And that was sort of a motivating factor for our study that we will come back to. So our data come from the Federal Reserve's survey of consumer finances. And there are two dependent variables that I want to highlight here. One is an indicator variable for whether a household has positive equities. And you can see the black-white gap in that variable. And also an equity share, a portfolio share out of financial assets. And we run our regressions on either one of those dependent variables. I'm just going to focus on one of the two because they're pretty similar. The explanatory variables are mostly motivated from the existing literature. You see the gaps in each of these variables: home ownership, income, risk aversion, financial literacy. For example, home ownership, there is a well-documented huge gap in home ownership between white and black households in the United States. And you might expect that that would contribute to the gap in equity market participation. Black households might be saving to buy a house and therefore hesitant to invest in the stock market. And so we include a lot of these that are from the literature. And then our variable that's a little more novel is participation in defined contribution retirement plans. Okay, so in the United States, this has become certainly the primary vehicle for individual savings. I imagine it's also in Europe, but I don't know that as well. So these are individual retirement accounts, often employer provided and frequently with some sort of employer matching going on. So I'm presenting the regression results here for one of the dependent variables, the equity share. The results are very similar if we look at the indicator positive equities in terms of statistical significance. And the explanatory variables, the controls, come out quite intuitive. For example, income is positively related to equity market participation, home ownership positively related to equity market participation, and so on. And in column 2, we introduce our variable here for defined contribution participation, and that's highly significant. Also raises the explanatory power of the regression quite a bit. In column 3, we find a very significant interaction term here that suggests that these defined contribution plans are particularly important for Black households. In the final column, we show average marginal effects. And you can see, for example, that homeowners' equity market shares are 6 percentage points higher. Households that are highly risk averse have equity weights that are 9 percentage points lower, and so on. The DC plan participation suggests that equity weights are 24 percentage points higher if you participate in a defined contribution plan. Also notable is the average marginal effect on the indicator variable for Black households is 2.3 percentage points after controlling for all of these other indicators. We're starting from a gap of around 11 percentage points, I believe it was, and you're left with 2.3% that's left unexplained, is one way to look at that result. Now, I said that DC plan participation raised equity weights by about 24 percentage points. That's an average effect, but we have this interaction term, so it's also informative to look at the difference by race, and you see that for Black households, the marginal effect is 35 percentage points. Another way to look at this table is to think about if all households had access to a defined contribution plan, that would essentially erase the gap, and in fact, suggest perhaps even higher weights for Black households, although that difference might not be statistically significant. At least bring them up to par. I moved fast. Your turn, Jeremy.
You did indeed. Okay, get to take some extra time. So thanks, John. I'm going to talk a little bit about the decomposition methods that we use in the paper. So thus far, what we presented is that we have a significant determinant of the white-black gap in equity shares with the defined contribution plan. And at the same time, we do have a sort of unexplained gap. After we control for everything, it's still significant that Black households have a lower equity share than white households. So we conduct a variety of decompositions in the paper that try to get at the other part of this. What is the explained gap? For instance, we know that higher incomes likely lead to more participation in equities. Well, if white households have more income than Black households, what is the contribution to that white-black equity gap if Black households had more income, the same income as white households? So to get at this, we're going to look at sort of blind or Oaxaca type decompositions. We're going to relax that assumption that all of the coefficients on these two groups act in exactly the same way. And again, what we're trying to get at here is identifying how these different characteristics, whether it's income, home ownership, financial literacy, how much do they contribute to that gap? Now, the problem we confront is we have a bunch of zeros, of course, in that equity share. And so our regression analysis is using a Tobit, and nonlinear decompositions can be particularly tricky. In the paper, we use 3 different methods. I'm just going to present 2 of them that are applicable to the equity share gap rather than the positive equity gap. Our first one comes from Wolf that basically says, well, let's forget about the trickiness in doing that nonlinear decomposition, because if we had that latent variable involved in the Tobit regression, we could use a linear decomposition on that latent variable. So he suggests, and we conduct in the paper, to simulate the latent variable with our regression, and then use, again, that latent variable in a very traditional blind or Oaxaca decomposition. The second method that we look at is the DiNardo, Fortin, and Lemieux decomposition, which goes back several decades, and been widely used, and is a quite nice technique here. What the DFL decomposition does is simply reweight our observations. For instance, we try to reweight the Black households with higher income higher than the black households with lower income, so they reflect the distribution of white characteristics. And we can do that simply by regressing our data set not on equity share, but rather to predict the probability that a set of characteristics would be indicative of a white household. So here's our results. The contribution, again, to that white-black equity share gap. And what you see, consistent with the regression results, is that DC plans are quite important. The latent variable suggests that equity share, latent variable decomposition, would reflect that a 5% increase in the black, decrease in the white-black equity share gap. Similar results for the DFL composition. It also points to the importance of home ownership, lesser so for financial literacy and income. So we see that DC plans again and again are very important in our results, and so we do zero in on these a bit more, and John's going to talk about how we do that.
Thank you. See, I kept you awake. There we go. I know some of you had wine with lunch. So yes, defined contribution plans playing a very large role. So we decided to dig a little deeper there. But first, a little historical context. So there has been a transition in the United States from traditional, what I would call traditional pension, employer-provided pensions that are defined benefits, to these defined contribution plans. And digging into the numbers, pretty interesting, I thought, to see, and this is not even far enough back to see when there were before defined contribution plans, but in the early stages here, you see that in 1992, black and white households had similar rates of defined benefit plans. And you bring that forward to today, and of course, there's a lot less of those. Both black and white households drop off by about 10%. Defined contributions have increased between 1992 and 2019, but the increase for black households lags behind, right? So a bigger increase for white households, from 40 to 51% as opposed to 31 to 38. Another way to look at it is to look at the overlap, sort of the total coverage. So there are some households that have both. And if you look at total coverage in 1992, 60% of white households were covered by one end or the other, 53% for black households. Coverage has increased slightly for white households, but has actually declined for black households. So you might say that the transition has actually been detrimental to black households. Okay, so these plans are important, but what determines the participation in these plans? They're not random, right? So you have to have the type of job or the employer that offers these plans, and then you decide to participate in the plan. Therefore, we analyze this in a two-stage process. First, being eligible and offered a plan, and then the decision to participate. There is some work in this area, but almost all the work that I could find was focused on that second stage: do I participate, and how much do I choose to contribute? And not as much on the first stage, am I eligible? And we find that even after controlling for a number of the worker characteristics and employer characteristics, that there's a significant gap here. Okay, so the controls: higher income jobs more likely to be eligible for a plan. Large companies more likely to offer a plan, certain industries more likely, others less likely. But after controlling for all of this, we find that somehow black households are less likely to be eligible for a defined contribution plan. I'll highlight that there was an income elasticity that varied by race, and we'll come back to that point in a moment. I know I need to keep moving. So the second stage of the regression here, the decision to participate contingent on being offered. Here, there is not a statistically significant difference. So it's not about the decision to participate in the plan, it's the eligibility where the difference is. Coming back to the point on the income elasticity, we find that at the top half top quarter of the income distribution, there's not a statistically significant eligibility difference. So the standard errors kind of overlap there. So if you're at the top quarter of the income distribution, black households, white households, you're equally likely to be offered one of these plans, to be eligible for one of these plans. But if you're at the median or below, you're significantly less likely as a black household to be eligible for one of these plans. Why might that be the case? Where is the discrimination coming from? We're not testing that. We're just throwing out some theories. And the one that I want to quickly highlight would be a job search theory. That if black households, got it? If black households are trying to have longer search times to find jobs, they may end up settling for employment with less benefits. That might be how they minimize their search costs, is to settle for employment that has lower levels of benefits. And that's less likely to be an issue at the top of the income distribution because all the jobs for high-paying workers have that benefit package. But on the lower end of the income distribution, there's probably more a variety of income and benefit packages. There's my conclusions, which I think we've pretty much run through. A key thing is it's not about the investment decision to participate. Instead, it appears to be about access. Thank you.
And now we have Ruth Badru is going to discuss the paper.
Okay, thank you for inviting me to discuss this paper, and it was a very interesting read. I will try not to bore you guys by telling you everything they've already told you, so we'll just sort of move straight into most of it. But the one thing I'll say is that I found the paper very interesting in terms of just sort of highlighting the racial wealth gap in the US, using this SCF data, and also kind of thinking of how this sort of DC plans contribute to, or might actually be a policy tool to mitigate against this wider wealth gap. And I thought that was actually a very good contribution from the paper because with DC plans, like he's mentioned, they're sort of automatic. However, when I was reading the paper, I think there were several thoughts that jumped through my head. I will share them with you because I want to. And so one of the first things was sort of, well, what if this is a socioeconomic difference as opposed to a racial difference? So what if this is actually the fact that maybe black households, if they are more concentrated in lower income distribution, they probably also have a high marginal propensity to consume and a very low marginal propensity to save, as economic theory would suggest. So could it not just be then that that is what's driving this gap that is observed? But the authors do control for that, and in the diagram that he showed before, they kind of show that at that lower income distribution, there is still this gap there when you compare white households with black households. And just sort of, they talk about the literature a lot. The research is very well situated within the literature, and I think they make a lot of reference to many of the transmission channels that influence their research questions. And I think where they deviate from previous studies is this introduction of the DC plans and the sort of automatic savings that can be used to improve black households' equity participation. I do have two comments, so this will be very short. The first one is sort of theoretical. So we know that the US does have let's say an interesting history with race. And so I think there is the component there about intergenerational wealth transfers that is perhaps missing in the research. And the SCF data does include information about inheritances, and I think it would be very useful to kind of incorporate that into the analysis to see how that is influencing equity market participation. And I think, especially even thinking of the historical context of the US, thinking about wealth accumulation and how that there's the evident disparities that are mostly intergenerational. There's also the fact that in the sort of intergenerational wealth accumulation might also affect who's getting what kinds of jobs. And I think even when you showed in your results just now as well, when you think about sectors like agriculture and mining, which are slightly more informal, there is that likelihood that, well, if you're entering into those informal sectors, you probably don't have the literacy tools in that sense to invest in this sort of markets, or even know that this sort of plans exist for you to invest in. And being a macroeconomist, of course, I have to think about broader macroeconomic factors. So things like market volatility, how does this change from one business cycle to the other? I know that the SCF data is collected over several periods, but it's not continuous and based on the same groups of households. But I think it might be interesting to see how the dynamics change from one time to the other. And of course, credit constraints are a very big deal if you're thinking about equity market participation. So just sort of exploring the sort of intersectionality, not just in terms of income, but thinking about how income interacts with these other systemic barriers, especially with the cultural and historical focus, might be useful as well. And my second comment kind of relates to my first. It's very sort of thinking about the empirical side of things and sort of thinking about this within group heterogeneity. So I know you account for age and education, but I also wonder with things like location, that might matter, especially with the US being having a federal system. You imagine that different states might have different sort of programs, different sort of incentives, and different drivers of equity market participation or even asset ownership overall. So I think maybe controlling for that might be useful, just to kind of really get where this is coming from. I mean, it could be coming from discrimination, but it could be coming from other factors that are leading to discrimination or as a result of discrimination. And so what I mentioned before, kind of using inheritance data from the SCF to kind of explore this intergenerational wealth transfers, how they affect the equity market participation and the racial wealth gap. And I think another thing to mention there as well is sort of thinking about culture as well. I think you highlighted the fact that a lot of people are probably saving for homes, but there's also the possibility that a lot of people are not so trusting in financial markets, and there might be some cultural incentives or kind of things at play there. And they do a good work in terms of trying to control for selection biases, but I wondered if you could also control for observational characteristics, so using a more propensity score matching. And I think this would help to kind of compare those who do participate in the DC plan versus those who do not. And it would help to strengthen the causal analysis, because at the moment, while your research paints a big picture or broad picture of what the drivers of equity gaps can be and focusing on this DC plan, I think there is still that lack of a causal link per se, and it would be good to kind of draw that out a little bit more. And I told you it would be short. Finally, it is a great paper. I enjoyed reading it, and I think it's really, it does provide a lot of useful information. I learned a lot reading it as well. And not to re-say the things I have already said, those are the summary of my recommendations. Thank you.
Great, so we have some time for questions. Nitish?
Is there a way to control for parental endowments?
Parental?
Yeah, hi. You got it.
Parental endowments.
Yeah. Let's see if there's anybody else.
Michael?
We take all the questions and then the answer? Yeah, there we go.
I forgot. I don't know if you answered this, but I didn't understand, why are black households less likely to be eligible for DC plans even after all your controls? What are the potential explanations?
Anything else? Why don't you get started on those?
Sure. So I'll take a couple of them and I'll leave the hard ones for Jeremy. So thank you, Ruth, for your comments. The intergenerational wealth transfers, that's related to your point as well. There are some questions in the survey that we could get at there. Certainly, that might matter in the first part of the analysis in terms of ability to invest in stocks. It's a little less clear how it would matter for the defined contribution analysis. However, Ruth did kind of suggest that it might impact your employment, and then, so there could be kind of an indirect story there, which I'd have to think a little bit more about, but it's definitely worth consideration. the question about why is that here? So we don't have the answer to that yet, and I kind of rushed through at the end some of our potential, but this gives me a chance to expand. So it's not, certainly it's illegal for a company to offer a retirement plan to a white worker and not a black worker. So that, pretty sure that's not happening. And so, there's something we're not controlling for, right? But our leading theory that I tried to explain a little bit was just that there could be sort of a spectrum of jobs, right? Where, and it's important to remember that this is at the lower end of the income distribution, right? At the median and at the lower quarter. There could be a spectrum of jobs there that black workers are sort of, because of discrimination in the labor market, they are sort of settling for jobs that have less attractive benefits. In other words, to get a job, the job search process is more cumbersome, more difficult, and there's probably different packages available in different types of jobs. And maybe black households are more likely to end up in the jobs that don't offer the plans, right? Because at the top end of the income distribution, 75th and above, one would imagine that for those high-skilled workers, competitive labor markets, employers are offering, all the employers are offering, right? And so maybe that kind of discrimination is happening more so at the low end of these. We don't have a test for that, right? But this is maybe hopefully motivating future research. And more broadly, the discrimination literature focuses mostly on income, but maybe we should also be looking at benefits. Jeremy, you want to chime in?
So I can talk a little bit about some of the great comments Ruth made in terms of expanding the analysis. Particularly inheritances is something that we have looked at. So that was a variable in some of our earlier regressions, and so possibly we can revisit that. Geography certainly is important. Most of that's not available to us. I'd have to go back and check. There might be state level data in SCF that's publicly available. Of course, a big state like California, right? What does it say to just put in a variable California's? But that's certainly something that we definitely could revisit. It is very interesting. The dynamics over time are very interesting, and whether that gap in equities is expanding or contracting. Me and John have talked a lot about which would be a fruitful area, I think, of future research, and that would allow us maybe to potentially look at macroeconomic trends over time and how they influence it. But yeah, thank you. Great suggestion.
One more quick. One of your other comments was about cultural differences and trust in financial markets. You could see our results as reflecting that, perhaps, that these defined contribution plans are a bridge, right? They kind of, if black households traditionally were hesitant to participate in equity markets and not willing to go see a financial advisor or not trusting their bank, but if the employer offers one of these plans, it's kind of an easy way in, right? And so I see the results as suggesting that, maybe this is one of the barriers to entry that has been lowered.
Yeah, Lisa.
I was wondering if you've looked at entrepreneurship and multiple job holding. Those are other reasons that a person isn't eligible because they don't work for an employer, or because they work for multiple employers but don't work a sufficient number of hours at any one employer. So I think those are both things I know you can do in the SCF that would be interesting to look at.
I don't think we've looked at that yet. But a good idea, thank you.
Yeah, we've I think played around with full-time and part-time work, but I think that would be definitely something that we should take a look at.
Okay, great. Well, let's thank our panelists.